1.9 billion euros. Vanished. Not stolen with a gun, not hacked, not lost in a market crash. Just gone. Declared missing by the company itself. On a Thursday morning in June 2020, one of the most celebrated technology companies in Europe, a member of Germany's prestigious DAX Index, valued at 24 billion euros just 2 years earlier, told the world that nearly 2 billion euros it had claimed to have on its books probably did not exist. The company was called Wirecard, and what happened next would expose the biggest accounting fraud in European history, and one of the most spectacular regulatory failures the world has ever seen. This is the full story. Wirecard was founded in 1999 in the Munich suburb of Aschheim, right at the peak of the dot-com bubble. Its original purpose was unglamorous: process online payments for merchants that mainstream banks wouldn't touch, adult content sites, online gambling platforms, the kind of business that traditional German banking wanted nothing to do with. In 2002, a 32-year-old Austrian named Markus Braun took over as CEO. He had a PhD in social and economic sciences, a background in consulting, and an extraordinary gift for corporate theatre. He wore a black turtleneck. He talked about digital ecosystems and the future of global payments with the kind of certainty that made investors lean forward in their chairs. The comparisons to Steve Jobs came quickly, and Braun didn't discourage them. Under Braun, Wirecard reinvented itself. It stopped being a payments processor for dubious websites and positioned itself as the financial backbone of the internet. In 2005, rather than go through the scrutiny of a traditional IPO, it merged with a dormant listed company, a backdoor to the Frankfurt Stock Exchange. In 2006, it acquired a small German bank, Excom Bank AG, giving it a full banking license and overnight credibility. By 2007, Ernst & Young, one of the big four accounting firms, had signed off on its books. Wirecard was clean, ambitious, and growing at 30% per year. In September 2018, 19 years after its founding, Wirecard was admitted to the DAX 30, Germany's most prestigious stock index. It replaced Commerzbank, a bank founded in 1870. Germany's tech future had officially overtaken its banking past. At its peak, Wirecard's market capitalization touched 24 billion euros. It was worth more than Deutsche Bank. And Jan Marsalek, the company's COO, the man who built its global network, was being whispered about as a future CEO. Wirecard's business model looked brilliant on paper. It sat invisibly between merchants and banks, processing payments, managing fraud risk, issuing cards. By 2019, it claimed to process transactions for merchants in more than 100 countries. But the engine driving its extraordinary profits wasn't the legitimate payment processing business in Germany. It was a network of 3 third-party acquirers, obscure companies based in Dubai, Singapore, and the Philippines that were supposedly processing payments in markets where Wirecard didn't hold the necessary licenses. These 3 companies, Pay Easy Solutions, Senjo Group, and Al Alam Solutions, were supposedly independent businesses. According to Wirecard's financial reports, they were responsible for handling transactions in Asia, the Middle East, and beyond. And crucially, they were responsible for almost all of Wirecard's profit. 60% of its global revenue, nearly 100% of its operating earnings, coming from 3 companies that almost no one had ever heard of, and almost no auditor had properly examined. The cash those companies supposedly held on Wirecard's behalf, 1.9 billion euros, was sitting in trust accounts at 2 banks in the Philippines, or so the financial statements said. Frank DiPascali fabricated account statements for Madoff. Wirecard's version was more sophisticated: forged bank confirmation letters, fake trustee account documentation, third-party partners who existed on paper, with offices and websites and contracts, but whose financial substance, when eventually examined, could not be verified. At its core, the mechanism was identical. Show regulators documents that look real. Move on. Clean. The warnings started early. In 2008, just 3 years after Wirecard went public, an independent German shareholder group called SDK published a report accusing Wirecard of falsifying accounts and manipulating its balance sheet. Wirecard's response was swift. They sued the report's authors. Germany's financial regulator, BaFin, launched an investigation, not into Wirecard, but into the people who wrote the report. EY performed a special audit. It cleared Wirecard. The stock recovered. The pattern was established. In 2016, an anonymous group calling itself Zatara Research published a report accusing Wirecard of money laundering, round-tripping, and processing illegal payments. The stock fell 20% overnight. BaFin's response was the same as before: investigate the short sellers, not the company.